Hey, welcome to BiggerPockets YouTube channel. This is David Greene, your host of the BiggerPockets Real Estate Podcast, here today with my partner, friend, and fellow investor, Christian. How are you doing today?
I'm investing. Invest in Bachelder. That's my new name now. I'm doing well.
Well, today we are going to talk about what strategies are working in today's shifting market. And I don't know about you, but it seems like a couple times a week, there's some new big news that come out that causes the market to shift over and over and over. Right now, it feels like you're kind of riding a surfboard. You're falling off backwards, and then you're trying to readjust, and then you're falling off forwards. And there's just this constant readjusting. So in some sense, it's more fun than ever. If you're a real estate nerd, if you like following the news, if you're paying attention to things, there's so much data to be analyzing right now. On the other hand, if you're a steady Eddie, this is probably terrifying for you. You're like, I just want a boogie board because I don't like falling. And I'm getting bounced all over the place on this surfboard. So I've been on a buying spree. You bought properties lately. You're intimately involved with every single one of my deals. That's one of the cool things about working together is you will look at these things together and problem solve. So based on what you're seeing from us and the 200 or so clients that we have with loans in submission, what are some of the strategies that you are seeing are working in today's market?
Yeah, I'm happy to finally see a resurgence of seller credits and getting stuff for market value. It's something that we just haven't seen in the last year and a half, 2 years. And those of you who have been buying, you've felt that struggle. Being able to have a seller cover your closing cost, being able to get properties for a fair value, and not have to waive every contingency you have and put your deposits at risk. Power shifting a little more back to the buyer, which is a welcome change for a lot of the industry as a whole in the last 2 years.
All right, so let's talk about what it is to have closing costs covered. Can someone get a credit for $500,000 on a $300,000 purchase?
Yeah, really good question. And this is something that there's a little bit of a misconception about because people do hear get seller credit and they think, what's the max? Typically with most loan products, there's going to be a 3% of the loan amount credit max for one party and up to 6% total. So depending on how many parties are giving you a gift, I don't want to call it a gift, but giving you a credit can add up to 6%. Now, one thing that you can run into is what if you don't have 3% of closing costs? A lot of people have asked, can I have the seller credit me some of my down payment? That is not allowed. The minimum you have to come to closing with, if you get everything else covered, that means your appraisal is covered, your title escrow fees is covered, your underwriting fee is covered, is what your closing costs are. If all of that's covered, you cannot have the seller credit cut into your down payment. So what we would choose to do is we would use that extra to buy down your interest rate. And that's what I would recommend because that's going to save you money over the long term anyways. Interest rates are on basically a tiered scale. It has to do with your credit report, your down payment, your debt to income. Everything goes into generating your rate stack is what we call it. And all that means, if you guys can think of a table, it has your rates everywhere from a 4% to a 7.5%, right? It has this huge range of interest rates. And every rate will have a dollar amount associated with it. So let's say the market rate right now is a 5.5%. You would have a $0 amount at that rate. So a 5.5% you can get for $0. If you go to a higher rate, so let's say you go to a 6%, you would actually get a lender credit. The lender would credit you to take a higher rate. You could also, when I refer to buying down your rate, you can go from that 5.5 to like a 4.875, and that would cost you maybe 2 points. And a point is 1% of the loan amount. Okay, so when I say using the seller to buy down your rate, if the seller is crediting you 2%, if you have a $500,000 loan, that's $10,000 the seller is giving you, you can use that to buy down a lower rate. Save interest in the long term.
And a lot of people don't realize it works the other way too. If you have closing costs that are high, you don't want to spend that much, you can actually elect for a higher interest rate and get a credit back towards your closing costs from the lender themselves, correct?
100%. And that's something that is very, very, very often overlooked and smart people have taken advantage of. If you know that you're not going to hold the home for 2, 3, 4, 5 years, it is actually more beneficial to take a higher interest rate, and you're going to have a longer break-even period. So if you sell the house before that period's over, you actually save money with the lender credit that's given at closing.
My personal opinion, interest rates are sort of the cars of the wealth building world. We all want to have a fancy car that everyone gets to see. We get to brag about, did you see my Rolls Royce? I'm driving a BMW. I have a Mercedes. People will often say, oh, I got this rate, and they throw it out there. And if it's less than everyone else, then it's like an ego boost. I will elect for the higher rate to get a bigger credit back from the lender, especially when the market was really, really hot and prices were going up and I knew I could refinance it in a year or two. And the capital meant more to me, especially if you're having a hard time saving money. Now, in today's market, this isn't as necessary. We're typically going the other way because the sellers of the homes are having to credit so much money. Now, you can do this when you negotiate the deal. When you're first buying the house, that's how I do it. I say, here's my purchase price and here's the closing cost credits that I want. I love doing that because for some reason, people like Christian and I will never understand this. But when sellers get an offer, they look at the purchase price and then everything else is just some detail they don't pay attention to. They don't look at contingencies. They don't look at the closing costs that you're asking for. So writing an offer for $1 million with $30,000 in closing costs is acceptable to them, but they would not have accepted an offer for $970,000, even though it's actually more expensive in a small way to take the $1 million offer because the commissions are a little bit higher on that higher purchase price. But it works, 60% of the time? It works every time.
Every time. I could have said it better myself. There's something with that mental valuation of just seeing that total number of what you want. It's funny that's I see that every day. It's very accurate.
Do you have anything to add on this specific strategy of getting in contract and then going after more?
I think a lot of people think, oh, I already got seller credit, so like it's already pre-negotiated, right? Like almost like the repairs are already pre-negotiated. That's not the case. The seller credit is part of your offer. Before you have, with most situations, it's before you have that inspection report. If it's a listing from David's team, it would be after you saw it, which would be nice. But once you get that inspection back, that's new negotiating terms, right? That's new territory that you didn't have when you wrote the first offer. So that seller credit's a thing of the past. How much are we getting for these repairs now?
That's a great point. Here's the way I look at it. I'm asking for a credit. It does not matter what I use that money for. That's my business.
Correct.
If I want to use it to make the repairs with the house, if I want to use it to buy down my rate, if I want to just put it in the bank and use it to buy my next home, if I want to take a trip to Mexico, it does not matter what that money is for. When we are asking for that credit, we will often say, my client needs this money to repair the fence. My client needs this money to fix the termite damage. It's just something that is said to get the other party to have some logical understanding of why they have to let go of their money. But what you're really doing is you're saying, give us this credit or we might walk away from the house. Let's talk about additional strategies that we are using to put stuff under contract. I have some I could talk about, but I'm going to turn it to you and see what's on the top of your mind first.
Yeah, I think in particular, David, I'm going to flip the script a little bit here and ask you a question.
That'll work.
What markets and what tactics to finding people specializing in that market are you targeting right now? I know, but so people know, where are you buying?
A philosophy that I have personally is at the top of a market, people are tempted to buy a cheaper home. It feels safer. So I can't give city names because everyone listening lives in a different area, but we all know what the best neighborhood to own in is, and we all know where we kind of want to avoid, those D-class areas. When you feel like you're at the top of a market, it is tempting to go to the D-class area and say, well, at least if the home is cheaper, if the market crashes, I'll lose less money. It could not be further from the truth, and here's why.
Correct.
When a market crashes, the D-class areas get decimated. The A-class areas have a hiccup, the B-class areas have a dip, the C-class areas get hit hard. But the nicest homes that there's more scarcity in are not affected nearly as much. So my approach is when I feel I'm at the top of a market, I will only buy in the best areas. If I'm on the way to the top, I'll consider a B. If I'm right in the middle, I'm okay with C. And if it's just crashed, that is the only time that I would consider buying in some of these D, I don't even want to say D, but maybe like C- type neighborhoods. The stuff I normally wouldn't touch. If it's 2010 and there's nowhere to go but up, that's the time I would consider buying there.
I love that.
Okay. Now let's take that approach. And the way I see it in my head, I often, when I'm trying to explain how I see stuff, there's like pictures that I'll see. I see this picture of like a flood. So like the market crashing is flood waters rushing in. A-class properties are at the top of a mountain. The flood is not going to get that high, right? Well, when we've already had a crash and all the flood waters have receded, buying something at the bottom is okay because it's going to rise to the top and then I'm going to get rid of it before the next flood comes. So let's take this understanding and apply it nationally. Are we at the top of a market? Probably. Is the market now starting to correct? I want to clarify. I will often say we're not having a crash. I believe that. A crash is like a ridiculous drop, a plummeting of prices. I think it is correcting. I think rates are going up. Demand is softening. Houses are not getting 10 offers at once. This is a good thing. We've been needing this for a very, very long time. So I'm careful about where I buy. This is not when I want to go buy in a market that could be exposed to the correction hitting it harder than others. So what I'm doing to stay at the top of the market in case the floodwaters come is I'm buying in areas that I believe the population is moving to significantly higher than others. The Southeast has been continuing to see a lot of growth. People are moving to that area. They like the warmer weather. This is because when Californians move into an area, they drive up the price. They're bringing a lot of money. The same is happening on the East Coast as New Yorkers are moving into Miami. They're bringing all their money and prices are exploding. So that's something I look for. I also look for areas with low or no state income taxes because wealthy people are going to prefer those areas. So those are the places that I'm buying in today's market. Now, could I go find a great deal in Kansas? I'm sure I could. Could I go find something that cash flows really strong in Indiana? I'm sure I could. But people are not moving to those areas. And to me, I have less slack that if something goes wrong, nothing protects me there. Something goes wrong in South Florida, something goes wrong in those states around where California is, I'm going to be pretty safe. Another thing that I'd say I'm doing to maximize out in today's market is I know that prices could continue to drop. So in general, I'm offering very aggressive offers. It's not uncommon for me to see a property listed for $750, $850 and write 100, 150 less than that. Now, I don't do that if the property's been on the market 2 days. It's a very good way to get a listing agent to not even return your call. But you see the days on market creeping into 30, 40, 50 days. All right, lower offers. Another thing that I'm looking for is the majority of what I'm buying, not everything, because sometimes I love the area or there's just not a lot of properties like this. It's like I'm getting it near market value, but I wouldn't have got it at all in the last year or two because too many people wanted it. So that kind of has a built-in protection. Other stuff, I'm like, no, this is a little more exposed that we could see more price drops in this area. So I'll only buy those properties if I have a value add opportunity. I want to be able to add square footage. I want to be able to change a floor plan. I want to be able to increase revenue if it's a short-term rental. What are your thoughts on some ways people can look for ways to add value to the properties they're buying as another hedge in case the market goes down more?
I love that. I think it all lands on comparables. I think buying the only 2-bed, 1-bath house on a block of all 3-bed, 2-baths is gold, right? Go buy that one 2-bed, 1-bath, offer less than $100K or $100K under asking because it's the worst house on the street, and go build that 3rd bedroom, and now you're comping to houses $150,000, $200,000 more. I think that's a tried and true strategy, and if you know how to target it and you're working with a realtor that can pull comps well and analyze correctly with you, 100%. I think that's a great strategy.
My favorite is to look for lazy realtors that pulled tax records and advertise that as the square footage of the home. So one of the ones I'm doing right now was advertised as a 1,300 square foot 2-bedroom, 2-bathroom home. It's actually an 1,850 square foot 3-bedroom, 2-bathroom home that also has this garage. So that's a home that is 500 square feet more than what was advertised, which actually works out to like 30% of the entire square footage that wasn't shown. That appraised significantly higher than even what it was listed for, let alone what I got it for, because it was not handled well and it was sitting on the market. I think it was on for like 65 days because no one wants to buy a 1,300 square foot house.
Yep. Everybody was setting their Zillow filters. Absolutely.
Literally, that's exactly what it is. So if you are the person who doesn't do the search the way everyone else does or ask the right question, you can uncover that this was the case. Now, furthermore, the seller of this home is leaving the country. So he has to get out of here. He's not backing out of this deal. There's any credit that I want to ask for, I'm going to get in this case because that seller has to go. So I tried, this didn't work on this deal, but I think this is a strategy worth looking into. I tried to assume his loan because he doesn't need it. He's going to be leaving the country. He's not going to be buying any more property. And he probably had like a 3.6, 3.7 based on when it was bought. I didn't get that far. He just said, no, I don't want to assume the loan. And I had already got so much from this guy that I didn't want to keep going. But that is another strategy people can use in this market that not a lot of people are thinking about. If your interest rate is going to be 7%, but they have it at 3% and they're not a full-time investor that this would impact them, consider writing a higher price for the home, maybe giving them an extra 20 grand if you can assume their mortgage, right? That's a significantly cheaper amount if you're getting it at 3% instead of 7%, especially if you're in like $700,000, $800,000, $900,000 purchase prices. What's your advice on that, Christian?
Yeah, I think the challenging part that a lot of people run into is financing the remainder, right? Because you still have to make up the difference, and his loan with the appreciation in the last couple of years is probably significant. But especially if you have a portfolio that you can leverage, you can cash out with one of your other existing properties and make up the difference and keep his 3.5-3% interest rate. Very powerful strategy. It has to fit the right circumstance. Somebody like in your seller's position, leaving the country, isn't going to need an American line of credit again. Doesn't really matter if that loan's still on his record. Higher chances of getting that accepted. Somebody who's maybe retiring and isn't going to purchase another home, higher chances. But yeah, if it fits the situation, I think that's a powerful strategy.
Christian, great job as always. It is a blast getting to listen to your big brain work through some of these solutions. For people that want to reach out, want to get a mortgage with you, want to talk with you about real estate, maybe want to invest with us, whatever the case may be, how can they get a hold of you?
Yeah, everybody, theonebrokerage.com. That's our website. Our application link is top right corner. And my email is christian@theonebrokerage.com, all spelled out, THEONE, brokerage.com.
You can also follow us on Instagram at The One Brokerage. And of course, you should subscribe to BiggerPockets YouTube channel here, where you get all of this fire information for no reason other than BiggerPockets really loves you. So for all of us at BiggerPockets, please let us know what you like about this show. Leave us a comment telling us what you liked. If you want us to get deeper into one of the strategies you said, we can make an entire video about just the strategy that you like the most. But we'll never know to do that if you don't tell us that that's what you want. So we want to give you what you want. We just need to know what that is. Also, tell us what type of topics you'd like to have additional videos on. I am David Greene. You can follow me at DavidGreene24 all over social media. And I'm happy to be the one bringing you this information. Thank you very much. Please check out another one of our videos if you have time. Subscribe to the channel and share this with someone you love. We'll see you on the next one.